Welcome to the Lynette Zang YouTube channel, where we support community and sound money globally. So critically important. Help us build this channel, please, and spread the word and create the community. And the best way to do that is by clicking that subscribe button below and hit the bell. We'll let you know when the next video is going on. And also by giving us a thumbs up on the way in so you don't forget on the way out. Leave us a comment too. But today, we've been talking quite a bit over the last several months on what's happening in the private equity market, because that's really the new underlying danger that we don't see, because we know risk has shifted, especially since the great financial crisis in 2008, which was when the system really died, to a new system. And private credit, well, it's grown quite a bit. Let's just dive right in. Private credit's second act raises some eyebrows. Private equity's foray into asset-based finance is fueling concerns over hidden debt and concentration risk. Because remember, with private equity and private credit, it's private companies. They don't have to reveal, making the danger opaque until it's too late for you to do anything about it, quite honestly. But ultimately, tight banking regulations have fueled much of the increased private equity activity. So the banks have shifted some of that risk into private equity. They've stepped away from it. Private equity has gone in. Banks are regulated. Private equity is not regulated. By now, the three kings alone, so the top three private equity firms, oversee more than $2 trillion, bigger than the U.S. junk bond or leveraged loan markets. Now, it does not mean that there aren't derivatives also attached to this private equity. And all of this is hidden. You remember I always talk about the iceberg, right? All we see is the tip of the iceberg. It's what's beneath the surface that nobody can see that is the biggest danger. As they spread deeper into everyday life, why are they still not being regulated? Well, as if that's really going to make a difference. You're going to have a crisis, and then they'll come in and do the regulations. They always close the barn door after all the horses have escaped. Private credit are the real hidden whales, not the banks. So the risk has really transferred from the regulated banks, or at least the quasi-regulated banks is what I really kind of call them, into private equity. In both cases, there are so many ways to hide the truth from you that you are not going to know until it's too late to do anything about it. That's why it's so important to build your position now. Food, water, energy, security, barterability, wealth preservation, community, and shelter. Get it done. Get it done. Because people think that if it's insured, then it's okay. We're going to be talking more about that in just a second. But asset-based finance is the new catchphrase. This type of lending is supported by cash flows from, say, credit card receivables or aircraft leasing, and has historically been the domain of the banks. Now it's over to private credit. But alternative managers' foray into the likes of auto loans, credit card debt is raising eyebrows, especially with the increase in delinquencies. In fact, Moody's Investment Services spelled out two issues. ABF, so that's asset-based finance, ABF, asset-based finance, are opaque, securitized instruments to start with. So they take this income and they turn it into a Wall Street product that they can now sell, okay? The involvement of private credit funds can build additional hidden leverage, especially if managers are allowed to enhance their returns with borrowings. So this is debt that you can't even see, but yet it's been turned into a financial product. So you're taking all the risk and you're paying all of these fees. And you're, what happens when this thing goes south? Who do you think loses? not the private equity companies. Then they'll be regulated afterwards, but it's the public that typically, eats it in the shorts. But more importantly, the agency is concerned about concentration risk, where a few large private equity houses are responsible for a fast evolving financial ecosystem and thus having an outsized influence in the economy. I mean, it's always the way that it happens. So my question is, would private equity be deemed too big to fail? I mean, we saw what happened with SVB Bank and who actually got bailed out, although, that's old news. No, it's not. It's current news. You just can't see what's happening. That's where the danger lies. If you can see it coming, you can prepare for it. If you can't see it coming, so therefore you don't think you need to prepare for it, you don't do anything about it until it's too late. You know, so many people think, well, all I have to do is I can do this right before it happens, rather. No, it takes too much time. I've been working on just the food part and energy, the mantra part of this since 2010. Okay, so in a very recent, the most current global financial stability report that just came out in December, private equity and life insurers. Isn't that interesting? The IMF report on private equity taking over life insurers and the impact that it could have on global financial stability. Because people think just because it says that it's insured, that means that it's safe. But the reality is any insurance is only as good as the counterparty to that contract. That is a contract. And if you have an annuity or any kind of policy, if you look at it and you actually read it, what it will tell you all over the place is that it's based upon the claims paying ability. So if they can't pay it, what good does that insurance do, right? So let's take a look at that. This is from that report. It is a highly concentrated industry, which means that a few big players are the ones that are holding all of the cards. And where you see AUM, that means assets under management. So that's your deposits that they're talking about here. As of the end of 2022, about 1,094 private equity companies, PE companies, exist globally. 1,094. With AUM, so assets under management, of more than $1 million. Of these, 534 are based in the United States, so roughly half. Now, let's look at the top 10 firms that control 31% of the global assets under management. Those would be Apollo, Blackstone, Carlyle are the top three, so they're in this bottom part here. And they control 19% of the global assets. That's huge. Then you can see the rest of them. Now, you may or may not be aware of what private equity firm actually owns the insurance company that you're counting on to pay you, but you might want to check that out. And that's easy enough to do. You can just search it. Who owns whatever? And that should come up. But let me show you the evolution of private equity into life insurance because they make so much money from this. That's why they're going there. And it's not overseen. That's the other thing. It's invisible. Private equity companies use a range of strategies in relation to life insurance companies. So we're going to be talking more and more about private equity, but for right now, we're just going to look at the life insurance companies. First would have been the way that they did it before. So a traditional leverage buyout where they would take your money in and then that money would go into a fund and then it would end up the banks also supplying funds for those leverage buying, and that all goes to the private equity company. So it kind of bounces up. There is controlling ownership is from the fund, not the PE company. This is the traditional way. There's your life insurer. And then the life insurer sends the premiums to the private equity company, and that is there's two different ways that they make their money. They make it on the top and they make it on the bottom. And they've done pretty well with it, right? There's your private equity company. Now let's look at the on-balance sheet, which is where more and more private equity companies are going. So they just own it directly. There's a private equity company and the controlling ownership. You are going to make the deposit to the life insurance company, but now the private equity owns it. So they take them offshore where they have even less oversight. And the life insurance companies send those premiums offshore. The private equity company creates these products like I just showed you. They get the fees. So you can see how they're more tied into this loop and they have a lot more control because they have controlling ownership. So they make even more money that way. And then the other way that they've been doing it is a strategic alliance. So they have the investors and they have the private equity company, more kind of similar to the traditional one in that they are taking your money directly to the life insurer, and they own a minority ownership stake in the life insurer company, but they create all of these products and they manage all of the investments at the life insurance company. And so guess what? Right? So they get the fees, they get the money, they have access to everything. And the trend toward private equity companies buying life insurers on their own balance sheet began around the time of the global financial crisis and has gained momentum from 2020 onward. And let me tell you, you never let a good crisis go to waste, right? This is part of the way that wealth transfers away from you is in jeopardy and you can't even see it because most people go, but it's insured. Well, any insurance policy is only as good as the claims paying ability of the insurer. And they are taking on more and more risks, particularly as interest rates have been held at zero, ZIRP, zero interest rate policy, for 15 years. And the life insurance companies have to pay out. So we've talked in the past about how this has forced savers to go and take on a lot more risk. This is all hidden risk. And this is the transfer of the danger from the banks, which are overseen by the central banks, into private equity and private finance that is opaque. Kind of like derivatives, opaque. Well, that means you're not going to see anything coming. Let's move on with that. Growth and asset allocation of private equity influenced life insurers. These are the assets of a private equity influenced life insurer, and look at how that's grown, accounting for a rising share of U.S. life insurance assets. You know, back in 2011, that wasn't even barely 1% of private equities owning life insurers. Now, on average, it's up to 10% and growing even more. That's why if you own any kind of insurance policy, it would really behoove you to understand who really owns that company. It'll help indicate some level of risk, but not all of it, because all of them had to take a lot more risks in that zero interest rate environment. Okay. So let's take a look at that because you're looking at about $850 billion worth of assets being managed by these private equity-owned life insurance companies. But private equity influenced life insurers own a significantly larger share of illiquid assets. What does that mean? That means that there is going to be, if they are forced to sell, if there is a run at the life insurance company, like everybody decides to cancel their policies and they have to liquidate assets, that means that they can value those assets up here. But if they're forced to liquidate them, the value to the market might come in down there. Right? So it's hard for you to even understand if the value of the life insurance company is real and stable or an illusion. It's an illusion. So let's take a look at that. These illiquid derivatives are what they are. And we've talked so much about derivatives. There is not one doubt in my mind, but what's going to overwhelm the central bank's ability to print their way out of this stuff, quite honestly, is going to be derivatives, because that's hidden. We can't see any of that. I don't even think we see the top 10% of it. Maybe we see 1 or 2% of the danger in there. But these are structured credit, private mortgage-backed securities, mortgage loans, other illiquid assets, private commercial mortgage-backed securities. These are all just derivatives. They're just contracts. And you can't, the thing about there's so many things about derivatives, but the thing about derivatives is that it's primarily about leverage. So it's debt upon debt upon debt upon debt, on average about 1,000 times leverage in these things. We can't see it, but how do you overcome that? You can't. So private equity influenced insurers, because they make all the money on the fees on the products that they create, sell to you without you even realizing it, because they're doing it inside of a life insurance company. So they get your money on the way in, and you're paying constant management fees. You're buying their garbage that is primarily illiquid, 46% illiquid. And who do you complain when it all implodes? Who are you going to talk to? You can bang on the door, but I mean, how easy is it even to talk to a human being these days if you're unhappy or you have a problem? They've hired gatekeepers. They haven't hired helpers. They've hired gatekeepers. So I really have to ask you, with all this illiquid garbage in there, all of this stuff that's hidden from you, do you still trust your insurance company? Do you really think that because it says it's a guarantee that it's safe? Pull out those policies, read them. You're going to find they're not as safe as you assume them to be. And assuming this with your wealth is not a good idea. You know how to not have to assume it? Right here. Okay? You hold it and you own it. Because if you don't hold it, you don't own it. And it is truly just that simple. And it is critical that you become your own insurance person. Because you say, well, but my investment is insured. It's like the FDIC insurance. I've shown you that 1,000 times. They have barely more than a penny for every insured deposit. You better hope they don't get a good run. So, but why is private equity getting into it? Because it's a flipping cash cow. That's why. Apollo's profits soared after Athene's merger. So after they bought the insurance company, this is where their profits were in 2008. This is where they were in 2023. Originating private credit assets to sell to its Athene annuities business is crucial for Apollo's growth. What do you think? I mean, seriously, I can't make this stuff up. There it is in black and white. You want to prove it to yourself? Do your own due diligence. Never take my word for it. Don't take anybody's word for it. But you can see it there in black and white. So it's good to be king. You go ahead and create these garbage products and you sell them to the company that you own. It's good to be king. But what happens to all the subjects that don't even realize that this is the kind of stuff that's in there? ABFs in turn come in handy because they often boast investment grade credit. So do you remember back in 2008? Okay, the mortgage-backed securities, the CDOs, right? Collateralized debt obligations. Collateralized debt obligations, right? This is the kind of thing that they're talking about, because what they actually did was, if the mortgage is over here and the mortgage payment is in, they pulled it out of there and put it in another bucket. Now, let's just say that you had crappy credit. Somehow magically, according to their algorithms and formulas, if you take a whole bunch of people with really crappy credit, their assumption was, according to their calculations, 20% of those mortgages were supposed to fail. So they simply priced it as if 30% were going to fail. So that is how you wash. And if you guys want me to do another video on this, I've done it in the past and I can show you how they take all of these people with really crappy credit and then magically that credit becomes AAA rated. Well, what can you do with AAA rated credit? You can put it anywhere, right? You can't there are going to be restrictions on what you can do with the crappy credit, but when you mush it all together, so when they're talking about asset-based finance, ABFs, asset-based finance, the product is the cash flow. So if especially in autos, mortgages, credit cards, I'm going to be doing a video very shortly on the rise in delinquencies. How do you think that's going to impact these ABFs? And that's what's sitting in your annuity. That's what's sitting in your life insurance policy that you think is so safe because it's insured. It's guaranteed. Well, yeah, only to the claims paying ability. You don't realize. So they are opaque. ABFs are opaque, securitized instruments with additional hidden leverage, debt upon debt upon debt upon debt, to really created a lot of this from credit that is subpar. But when it's mushed with a whole bunch of others, there you go, ABF. So credit, they're often investment grade credit ratings until they don't. And you don't want to be left holding them when they don't, but you don't have any control over that if you've put your money into an insurance company. I mean, spread-related earnings, or the money it made from investing policy holders' premiums, reached $3.1 billion, accounting for over 60% of the firm's total profit. I've shown you so many times before how the banks also, we're talking about private equity. Well, what, you think they're going to do it different than the banks? They'll be less visible, but most of the profits that the banks are making, they're making some pretty darn good profits, are based on their trading. Right? They're not based, we were raised to think that, okay, you make that deposit and then the bank loans it out, and the difference between the fee that they collect on what they loan that debt at and how much they have to pay you to borrow it, the interest they're paying on your deposits, that's their profit. And yes, they still do some of that. But by a wide margin, more of their income is generated by creating garbage products and by trading. And that's what private equity is doing too, except it's not overseen. And I can't even honestly feel like the banks are overseen, because honest to God, the central banker's job is to protect the banks, not you and me. It's their job is to protect the banks and stay relevant. You have to become your own central banker. Or because you have to be looking out for what is in your best interest first. That's what my work is all about, to make sure that you understand what's happening so that you can make educated choices that put your best interest first. That's where it should be. Here, we start with goals and we look at your circumstance and what you have to work with. And we create custom strategies based upon historic repeated patterns. Now, we can't do it quite yet, but we're very, very close. So just give us another minute. We're working on it. Believe me, we're working really hard on it. Okay, so let's just go back and take a look at what's happening in the shift. This is just bar and coin investment. And I actually don't even care where it is in the world, but it happens to be the West versus, which means the U.S., the developed nations, versus the East, so China and nations that are still evolving. And you can see quite clearly, those are the color codes, that just like the arrogance of the central bank, of the Federal Reserve to think, well, the dollar is king, that can't happen, so we don't have to keep pace. It's the same kind of thing. The East is preparing to hold their power. That's what you need to be doing too. And how do you do it? You do it by being as independent and self-sufficient as you can. So if they say jump, you go, nope, not gonna. How do you vote? You vote with your wallet. We can do a peaceful revolution just by positioning into gold and silver and making sure that you have food, water, energy, security, barterability, wealth preservation, community, and shelter. Okay, so let's just go back and take a look. Because the reality is, it's the safest insurance. Why? Because it runs no counterparty risk. This is according to the Bank for International Settlements, right? There are so many things about gold, but the key is that this is the only financial asset, their words, not mine, but I agree, the only financial asset that runs no counterparty risk. You hold it and you own it outright, period, end of discussion. You need to become your own central bank. You need to become as independent and self-sufficient, and that's why community has risen to the top of the list. Because, people say, well, you can't eat gold and you can't eat silver, but it's universal money because it has the broadest base of buyer and the broadest base of functionality. So no matter what is happening, there is always a buyer. Maybe it's more, maybe it's less, but there is always a buyer 100% of the time. That is what 6,000 years of history has proven. Is this time different? Is somehow magically this going to regain any of its purchasing power? Nope. This is just going to its fundamental value, which is zero. This has never gone to zero. And it never will because it's got the broadest base of buyer. It's not rocket science. It's just logic. So if you want to give us your support, please do. Please like us. Leave a comment. Share, and make sure that you watch the rest of our videos because we're constantly putting out content to help you get prepared. But honestly, the best way is subscribe. Hit that button. We'll let you know when we're going live. And I know people will put questions in the comments section, and that's great, but if you could also send them to questions@LynetteZang.com, your question is more likely to be seen than if you just put it in the comments because you see, thank goodness, and I love this, thank you guys so much. We get more and more and more comments, so it's kind of hard to ferret out the questions. If you want your questions answered, because we'll answer all of them, either on a video or in the podcast, then the best way to do it is questions@LynetteZang.com. Because we are all in this together. We are a community, and I love this community. I can't even tell you how grateful I am that you guys are here and watching this and help us build this, because we need local to get through when things get very local for a minute as people start to recognize the hyperinflation. And there's a whole strategy to that. But we also have to do this globally because that's the only chance that we have at having a seat at the table in the new system. One that is a lot more fair, that maintains your purchasing power better, but you still need to become your own banker. Because if you don't hold it, you don't own it. We are definitely all in this together. Everybody here at LynetteZang.com is here to be of service, and we hope we're doing a good job and definitely having the freedom to do what we know is the right thing to do for you, our viewer, for our community. And until next we meet, please be safe out there. Bye-bye.